Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today on Cable TV 10 in New Bern, 94.1 WNBU, as well as viewers and listeners streaming us from our website at www.dlblain.com. During the first segment, we're talking about the federal government's Thrift Savings Plan, or TSP. If you missed that, log on to our website, www.dlblain.com, and download it from the archives. What I'm going to start with this segment is with the federal government reaching its debt ceiling limit last week sometime. There are many articles in the media noting that part of the temporary solution of this debt ceiling problem was suspending investments in the G Fund in Treasury securities. The G Fund in the TSP is very unique in that the Treasury issues special securities, and one of the solutions to meeting the debt ceiling is to suspend those issuances. And so there's caused a lot of concern for investors in the TSP, and I wanted to clear up some of the confusion surrounding that. So one thing, number one, your ability to withdraw money from your TSP or make loans from the TSP is not impacted at all. Those are still able to, you're still able to do those things. Secondly, that there are no, in 1987 there was some federal legislation that said the federal government would pay earnings on the G Fund investments even when the Treasury Secretary cannot issue those securities, and that was signed into law May of 1987 by President Reagan, and has functioned on many occasions since then to allow the TSP to operate normally. So the bottom line is that even though there is a provision to suspend issuance of Treasury securities for the G Fund, the effect of it has really been unnoticeable to the plan participants. So we recommend, at least at this time, that you not worry about the federal government reaching the debt ceiling. As far as your TSP goes, of course, we have some concerns in general about the government's debt ceiling, but specifically related to investing in the G Fund for your TSP, it should not impact that. For the rest of the show today, I'm going to start, I probably will not finish today, but we're going to start with something that is a topic that I get quite emotional about because I see so many people, frankly, getting ripped off. This weekend, I had to drive to Raleigh early on a Saturday morning for a meeting in Raleigh. And as I was driving, I was listening to the radio, and there was a plethora of financial shows on the radio. To the outside, they would seem similar to what I'm doing here. And, you know, naturally, being that my industry, I tune into them and I listen to see what other people were saying. And frankly, I was appalled. The number of people out there that are hawking products, namely annuities, and disguising them is disgusting. And we're going to talk a little bit today and give you an alternative point of view on these annuities. The big theme on these shows that I heard just station after station, hour after hour, was guaranteed income and security and playing on people's fears of running out of money, playing on people's fears of the market decline of 2008, 2009, and buzzwords like income planning and guaranteed income and things like that. And it just really, I felt like we needed to get an alternative point of view out there. Let's be honest, these annuity products, they're sold. You have to be a licensed insurance agent to sell an annuity. You have to have some sort of securities license to sell a variable annuity. And these are products that are sold, not purchased by consumers. Very few consumers wake up and say, gee, I think I would like to pay a huge commission, pay huge ongoing fees to buy this product that has a prospectus that's 6 inches thick, written by a bunch of lawyers that I cannot possibly understand. Nobody wakes up and decides to buy that type of product. Make no mistake, they are sold. And so we're going to talk a little bit about those. A couple of things. Number one, they've got poor liquidity, the surrender fees, the ongoing annual fees, the insurance fees, the mutual fund fees, and frankly, they're too complex. 99% of the people selling these things don't understand them. I have a hard time understanding the complexities of them. And anything that requires 700 pages of fine print to explain to you, I would encourage you to run away. If you're relying on the crafty explanation of how this thing is going to pay you guaranteed income for life from somebody, I would just be very cautious. They underperform their promises. They underperform the market. They underperform any illustrations that they may give you. They'll give you some fancy charts and graphs that tell you how much money you're going to make and this guaranteed income. And frankly, over time, they have severely underperformed these promises. The bottom line is they're better for the salesperson than the investor. And the other thing is they're only good as the insurer that is issuing the policy. Now, granted, a lot of them are name brand insurers, but there are other insurers, and you're relying on the guarantee of the insurance company. And we see what happened in the financial crisis. The largest insurer in the world, AIG, had to be bailed out by the federal government. And so these guarantees are guarantees of the insurer that you're investing with. And so they have a lot of problems. We're going to get into some of those specifics. We're coming up on a break here, but when we come back, I'm going to go over some of the basics of these annuities, why they're sold, and why they're not a good idea for the average investor. So for All Things Money, I'm David Blain, and we'll be right back after a short break.